You've got a side hustle that's finally working. Maybe it cleared 20 grand last year, maybe 40, and every Sunday night you do the same math in your head. What if I just did this full time? Here's the mistake that wrecks that jump. People quit on revenue instead of quitting on net. They see $90,000 in 1099 income and think, that's basically my $90,000 salary. Except it isn't, not even close. Because the second your employer disappears, you pick up the full 15.3% self-employment tax on your net earnings. And according to the Kaiser Family Foundation's 2025 Employer Health Benefits Survey, employers cover an average of $19,276 a year of the premium on family coverage. That's a number that just moves onto your side of the ledger overnight. So a $90,000 gross freelance year is not a $90,000 job. It's closer to a $60,000 job with worse hours. And most people don't find that out until March. So what actually tells you it's time? Not confidence. Not a good month. 3 specific financial triggers, and 2 signals that feel like proof and absolutely aren't. Let's start with the first trigger, because it's the one people get closest to right and still blow. You need your side income, replacement adjusted, to cover your baseline expenses. Replacement adjusted is the whole ballgame. Take your gross freelance revenue, subtract your real business expenses, and now you've got net earnings. That's the number the IRS actually taxes. Multiply that by 92.35%, because self-employment tax applies to 92.35% of net earnings, and then apply 15.3% up to the wage base, which the SSA has set at $184,500 for 2026. Let me run it with real numbers. Say you net $70,000 from freelancing. 92.35% of $70,000 is $64,645. Self-employment tax at 15.3% on that is about $9,891. You get to deduct half of that on the front of your return, roughly $4,945, which softens the blow on income tax but does nothing for your cash flow this year. Then health insurance. Then you're covering your own paid time off because nobody's paying you to have the flu. My take: don't quit until you're trailing 12 months of net freelance income, not your best 3 months. The trailing 12 clears your baseline expenses, plus that self-employment tax, plus your own premium. For a lot of people, that means the side hustle has to hit somewhere around 130 to 140% of their old take-home pay before it's actually break even. That feels insane the first time you hear it. It's just arithmetic. And yes, your number moves. If you're on a spouse's employer plan, you can strike the health insurance line entirely, and your trigger drops by $15,000 or $20,000 of required revenue. If you're single with an ACA Silver plan in a high-cost state, it goes the other way. Run your own version, not mine. Now the second trigger, and this is the one I'd fight someone about. You need cash, and specifically you need cash sitting in 2 separate buckets that do 2 different jobs. Bucket 1 is your personal emergency fund. Bucket 2 is your tax reserve, and freelancers conflate those constantly. Then get to April 15th and discover their emergency fund was actually the IRS's money the whole time. Quarterly estimates are due April 15th, June 15th, September 15th, and January 15th. And the safe harbor is straightforward. Pay in 90% of this year's tax or 100% of last year's total tax, 110% if your prior year adjusted gross income topped $150,000, and the underpayment penalty goes away. That's it. That's the scary thing everyone avoids. It's a percentage in 4 dates. Why does the cash matter more for freelancers than for a W-2 employee? Because the shape of your income changes. According to the Federal Reserve's 2024 Survey of Household Economics and Decision-Making, 63% of adults said they could cover a hypothetical $400 emergency with cash or its equivalent, meaning better than a third couldn't. And gig income is lumpier than salary by construction. The Fed's same survey found 36% of adults did some form of gig work in the prior month, and the vast majority of them were doing it alongside other income, not instead of it. So here's what I'd do. 6 months of baseline personal expenses in cash before you give notice. Not 3. 3 is W-2 advice. W-2 people get 2 weeks notice, severance sometimes, and unemployment insurance. And as a self-employed person, you generally do not qualify for regular state unemployment benefits at all. That's the part nobody says out loud. Your safety net isn't smaller, it's structurally different, and you're the one funding it. Separate business checking account, separate tax reserve, and every time an invoice lands, you move a fixed percentage straight out. I like 30% for most people at moderate income, but if you're in the 24% federal bracket with a state income tax on top, 30% is thin, go 35%. Third trigger, and honestly this is the one that separates people who freelance for 2 years from people who build something. You need a retirement plan you can actually fund, opened before you need it. This is my hill. Most freelancers overpay the IRS for years because they set up a solo 401k too late. Here's why timing matters so much. A solo 401k lets you contribute as both employee and employer. For 2026, the employee deferral limit is $24,500 per IRS notice 2567, with an $8,000 catch-up at 50 and up, and a super catch-up of $11,250 for ages 60 through 63. On top of the deferral, you add an employer profit-sharing piece, roughly 20% of net self-employment income for a sole proprietor. And the total defined contribution ceiling for 2026 is $72,000. Compare that to a SEP IRA. Same $72,000 total ceiling, but a SEP is employer contribution only. No $24,500 deferral. So, at lower income, the solo 401k wins by a mile. Someone netting $60,000 as a sole proprietor can put in the full $24,500 as an employee deferral, plus roughly $11,000 or so on the employer side. Call it $35,000 of a $60,000 year. That same person with a SEP is capped near $11,000. Identical income and one plan shelters 3 times as much. That's the whole argument. Now the timing trap, a solo 401k generally has to be established by the end of the tax year to make employee deferrals for that year. Secure 2.0 loosened this a little for sole proprietors setting up a brand new plan, but I wouldn't build a strategy on the edge case. Set it up before December 31st of the year you go full-time. Fidelity, Schwab, and Vanguard all offer solo 401ks with no plan fee. There's no reason to wait. And if your net is under $30,000, or you might hire a W-2 employee within 2 years, the calculus shifts. A SEP or even just a plain Section 408 traditional IRA at $7,500 for 2026 might be the cleaner start. Your income level decides this, not a rule of thumb. While we're on deductions, let me kill the phrase that costs freelancers the most money. Just write it off. That's the single most misunderstood phrase in this entire business. A write-off is not a rebate. When you deduct a $1,000 expense, you don't save $1,000. You save $1,000 times your marginal rate. In the 22% bracket, plus that 15.3% self-employment tax on the same dollars, a legitimate $1,000 business expense saves you roughly $340. You still spent $1,000. Buying a laptop you don't need to save on taxes is a 66-cent on the dollar way to lose money. What actually moves the needle is the stuff you were paying for anyway. Section 162 covers ordinary and necessary business expenses. Section 280A gets you the home office, and if you use a room regularly and exclusively for business, the simplified method runs $5 per square foot up to 300 square feet. A $1,500 maximum. Mileage for 2026 is 72.5 cents a mile under IRS notice, 2610, which means 6,000 business miles is $4,350 off your net. Then Section 199A, the qualified business income deduction, can knock up to 20% off your qualified business income before you ever compute income tax, subject to income thresholds and your filing status. Those 4 things, stacked, beat any shopping spree. That's real money, and you don't have to buy anything to get it. Now the 2 false signals, because these are what actually push people out the door at the wrong moment. False signal number 1, one great month. You billed $14,000 in October, and your brain immediately annualized it to $168,000. Don't. Freelance income is seasonal and client-concentrated in ways salary never is. If one client is more than 40% of your revenue, you don't have a business. You have a job with no benefits and no protection. And on that, the Fed's household survey found that among people doing gig work, most treat it as supplemental for a reason. Lumpy revenue is the default state, not a phase you graduate out of. What I look for instead is trailing 12 months of net, with your worst month still covering your baseline. If your worst month can't do it, you're not ready, no matter what October looked like. False signal number 2, and this one's more emotional. Hating your job. Real feeling. Terrible trigger. Burnout tells you something's wrong with your current situation. It tells you nothing about whether your freelance economics work. I've watched people leave a $95,000 salary for a $40,000 net freelance year because a manager was awful, and 18 months later, they're back in a W-2 seat with credit card debt and a gap on the resume. The move there isn't quitting. It's changing employers while you build the freelance side to the trigger point. And there's a third false-ish signal worth naming because it's the one financially literate people trip on. A big pipeline. Signed letters of intent, verbal yeses, "we'll definitely have work for you in Q2." Pipeline is not revenue. Payment terms are net 30 at best, and plenty of clients run 45 or 60. So money you booked in March can land in May. According to the IRS, if you're paid $600 or more as an independent contractor, a client generally issues a 1099 NEC, but that form shows up in January, long after you needed the cash. Count deposited dollars, nothing else. I help solo workers and gig workers stop overpaying the IRS, and the pattern I see over and over isn't people who quit too late. It's people who quit on gross revenue with 3 months of savings and no solo 401k, then spend 2 years digging out of a hole that a single spreadsheet would have prevented. So the sequence I'd run: trailing 12 months of net freelance income covering baseline plus self-employment tax plus your premium, 6 months of personal cash in one account, and a tax reserve at 30 to 35% of every invoice in another, and a solo 401k opened before December 31st of your first full year. Hit all 3 and the leap stops being a leap. It's a transfer. One more thing that trips people at the exit: timing your quit date. Inside the calendar year changes your tax picture more than people expect. Leave in January and you've got 11 plus months of self-employment income, 4 quarterly estimates, and no W-2 withholding cushion. Leave in October and your employer already withheld most of your annual tax, which often means your prior year safe harbor is already satisfied and your first quarter estimate as a freelancer is smaller than you feared. I'd lean toward a Q4 exit for that reason alone, plus you get to max your employer 401k deferral first. And remember, the $24,500 deferral limit for 2026 is per person, not per plan. So what you put in at the day job comes off what you can defer into the solo 401k. The employer profit-sharing piece is separate and still yours. Your bracket and your state decide which quarter is actually optimal, so check yours. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this was useful, subscribe. I put out the stuff nobody handed you when you went solo, and you don't want to miss the next one. And if there's a specific 1099 or self-employment tax question you've been avoiding, drop it in the comments and I'll build a video around it. Go run your trailing 12 today.